Hello everyone, CA Vaibhav Jain here, and today I will be discussing financial modeling with you. If you are someone who is either a fresh graduate who wants to understand how to do financial modeling, or someone who aspires to join the venture capital or investment banking as a career option, or someone who wants to learn it for their own purpose, this course might be relevant for you. But before you begin this course, you should have a basic understanding of Excel as well as financial statements. Um, Due to time restrictions, I will not be able to deep dive into how to operate Excel one and how to read financial statements second. So those two become a prerequisite for this course. Apart from that, as the name suggests, this is a financial modeling course and not a valuation course. So you should expect to learn how to make a financial model by the end of the course, but not valuation. Valuation comes after you have built your model. You can then do a terminal value followed by a DCF valuation exercise, which I am not going to do in this video. Lastly, on the structure of the video or the structure of the course, firstly, as you know, we are discussing only financial modeling. There can be two major ways. Either we can build out a monthly model and then do a summation and go to a annual model, or we can directly build a annual model. Given that almost the operation would be same for both of these models. Hence, I would be making a annual model to save time, right? Second, I think one major point here is that you might be expecting for me to take a listed company, put the data, and build out a model. I can do that, but there will be some challenge. For example, in model, I will be taking some assumptions wherein I cannot get the historicals for those assumptions from the financials of the company. And that would actually restrict us from making a fully detailed model. So on that note, I thought that I will make a model from scratch for a company, assuming that it is a new company, and we will take year one as projections itself. Later on, if you feel, we can make another model wherein we plug in the actuals of the company and then build out projections by taking some assumptions here and there. So yeah, broadly, that's what I had written for my intro. Maybe I can introduce myself as well. As you know, I am a chartered accountant. I qualified in 2019 with All India rank 34, post which I have worked in investment banking and venture capital as well, and have made models, have reviewed models. So that's where I'm coming from. Maybe at this point, we can start building out the model, right? So let me just make a intro sheet of sorts. This will contain any discussion which we are having so that it is recorded in text, right? Now, let me come to the structure of building any model. This is for any business model, any industry which you're thinking of. There will be a couple of common sheets. If you think of the common or the general sheets, you will firstly make financials in any model, balance sheet, profit and loss, cash flow statement, notes to financials, assumptions sheet or the input sheet. So these five sheets are the bare minimum you have to do. What I do is I add one more dashboard sheet or the summary sheet wherein all the key output is seen at one place. Then there can be some industry specific sheets. So let's say if you're making the model for a SaaS company, in that case you'll have maybe a customer sheet wherein you are projecting how many customers are there, how's the churn. You can also have a retention sheet wherein you are making cohorts for customer retention. This can also apply to any other business, but I'm just taking random examples here. In our case, I will be building out model for a fintech company. So fintech lending company. In that case, we need to know what is the loan book of the company. So we will be making something known as AUM sheet or assets under management sheet. It is essentially the loan book. We will be making something known as the debt schedule. Debt schedule is a separate sheet because for lending companies, debt is the raw material. And hence you need to have a proper working to forecast what is the debt requirement of the company, right? Within the general sheets, we can make one schedule for assets. We can make one schedule for employees, to forecast how many employees will be there, to forecast what sort of investment we will be doing in the asset and what would be the depreciation thereon. Okay. I will add to this sheet once we are building out the model if there is any other sheet that we are making. All right. So let's start with our structure of the model. Firstly, I will be building out the financial structure. Remove grid lines from here. So I will build out a balance sheet, PL, cash flow statement, notes, assumptions, dashboard. This dashboard I'll drag before our financials because this is output. And actually, I'll just copy before assumption. So I can just name this as my placeholder where my working starts. So I'll make assumptions, asset schedule, employee, right? AUM, and also debt. So these are the sheets which we picked out in the beginning, and we have made separate sheets for each of those. Now, how to start building out the model? So let's say I'm building out the model for company X Limited. So I will link in the balance sheet to company X Limited, and this is the balance sheet. So naming the sheet. Now the format of balance sheet particulars. Let's say I'm doing FY24 as the first year and FY25 as the second year. This is a 5-year model, so taking till FY28, right? Now slide formatting. This is how the model essentially will start. I'm freezing this particular place. Now understand how to make the model navigatable. Uh, if I put every line item in column A itself, I will not be able to navigate within the sheet. So what we do here is, for example, we will have assets, we will have liabilities and equity. So rather than putting the subsections within assets in the column A itself, we will use column B. So there will be financial assets and non-financial assets. And there will be financial liabilities, non-financial liabilities, followed by your equity. And now again the same logic. Rather than writing the financial assets in column B itself, I'll use column C. So within financial assets, I'll have cash and cash equivalents. I'll have trade receivables, investments. Given we are making AUM, so AUM as well. AUM is essentially my, let me put it this way, loans and advances, which is essentially my AUM. Within non-financial assets, I will have property, plant, and equipment, intangible assets, maybe something other non-financial assets. Maybe here I'll put other financial assets. Similarly, now in financial liabilities, I will have borrowings, trade payables, other financial liabilities, financial, and within non-financial liabilities, let's stick to only two provisions and other non-financial liabilities. Okay. Now, within equity, you will have your equity share capital as well as reserves. But when I am breaking down these two and I'm assuming a fundraise within the model, then I will have to break that fundraise into the equity face value as well as the share securities premium reserve, which means that I'm saying that I will be raising money at a certain valuation which I will be allocating in the model. As a banker, you might not want to do that. You might not want to say that we will be raising money at this particular valuation. So in that case, what you can do is rather than breaking down these two line items, you can just put a single line item as shareholders fund, right? Now for column A and B, I'll just reduce the width. So this is how my balance sheet is looking right now. And I will have my total here and total here. Got it? And maybe I'll just put a check that my total is tally. Similarly, now I'll build out the structure of the P&L. Control W I pressed, which actually helps me to keep the column width same. So within P&L, we will have revenue from operations. We will have other income, total income, employee benefit expenses, operating expenses, depreciation and amortization. In our case, it is a lending business, so we'll have credit cost, something known as credit cost, which is essentially the provision for bad debts which we are making, or the write-offs as well. You have your EBITDA, EBIT, finance cost, PBT, taxes, VAT. ठीक है? This broadly is the structure of my P&L account. Now I'll just build out the structure of my cash flow statement. First I copied, then Control W. Cash from operating activities, cash from investing activities, and cash from financing activities. Then some VCO, opening cash, changes, closing cash. ठीक है? Opening cash will be 0. Changes will be the sum of all these three, and then we'll have our closing cash. Lastly, I'm making my notes. Notes to financials. Okay. So I will stop right now. This is how we just laid out the structure of our financials. And now we can start by projecting the line items. Now, if you have to think of it, you have to think where to start. Where I am thinking right now to start is in my P&L account and from the first line item itself, revenue from operations. Okay. So in the notes, I am going and writing revenue from operations. In our case, I am building out the model for a simple lending business. If you do not understand how lending works, I will be making a video on how lending works in my other channel where I do some case studies and all. So you can go and watch that before you start this at this point. So you'll understand how lending works, and then you'll understand how to model for that particular business segment. So let's say I'm building out for a lending business. The main income for a lending business is the interest income from the loans given. There might be other incomes. For example, there will be processing fees. So you can write processing fees if you want. But actually processing fees comes under other income. Okay? There will be processing fees. There might be something known as, let's say, treasury income because they will have excess funds to invest. So that again, treasury income will come under my other income. Okay? So the primary income, as you know, is the interest income on the loans given. Now, one thing I'll do, let me make two sections. One is P&L assumption and one is balance sheet assumptions. Okay. So for P&L assumptions now, I am doing for revenue from operations. I need interest income on loans given, which means I have to understand how to forecast interest income on loans given. So there can be two approaches. One approach is either you calculate the loan book or the AUM and then take certain percentage on the AUM as your interest income. That is a correct way to do it, but not a detailed way. A detailed way or a more comprehensive way to build it out is to take it at the disbursement level. The difference between disbursement and AUM, if I'm lending 100 rupees right now, by the end of the year, I will get some repayment from the customer. So 100 rupees is my disbursement, and let's say the customer has repaid me to me 30 rupees, out of which 10 rupees was interest and 20 rupees was principal. My AUM is 80 rupees and 10 rupees is my interest income. Now I can either use an AUM approach or a disbursement approach. The detailed way is the disbursement approach, and hence we will be taking the disbursement approach. So to calculate that, I need my disbursement. Okay, so I need to calculate disbursement. So for disbursement, I'll have to take some assumptions. Hmm. Disbursements. Now, how can you calculate disbursements? The disbursement amount is a function of the cases disbursed multiplied by the average ticket size, which is basically the loan amount per loan you are giving. So it is a function of these two. On average ticket size, it is easy that we take a simple assumption that we'll be lending, let's say, 50 lakh rupees per loan. Okay. This is a simple assumption that I'm taking. But for the cases disbursed, I need to take a more comprehensive approach. So for cases disbursed, either I can take a direct approach that, okay, we have, let's say, 1000 cases this year and 20% growth next year. That is a very simple way of doing it. A more detailed way would be to think of how to get those cases disbursed. So that would be a function of, let's say, what sort of channels I'm using to acquire the customers. So for cases disbursed, let's say I'm using performance marketing, I'm using, let's say, organic or word of mouth, and I will be using, let's say, influencer marketing. So maybe these three channels are the key channels, and I'll then forecast how many customers can I reach through these channels, multiplied by what is my conversion rate through these channels. That will give me how many cases I will disburse. But now I'll take a pause here because there is some important adjustment we need to do right now before starting the model, which is the currency switch. See, now I'm making it out in INR, in dot INR. So 50 lakhs I've written as 50 lakhs. But what if tomorrow I have to convert this entire model into crores? Because at the end of the day, if I'm building a model where I have a amount, say 5,000 crores, if that entire 5,000 crore is being written in one cell, it is very hard to read the model. So it's better to convert it into some currency. And this is where we make the currency switch. So I will tell you how to make a currency switch. So you will see that particular function, right? I am going to my dashboard to build that out. Currency switch. The currency switch, you have to firstly think which all currencies and units you want. I only want INR crores. and USD millions. Okay. I'll use these two currencies, which means that if my model is being built in INR itself, I do not need to divide it by anything. Just I'm writing one. But if I want to convert it into crores, I'll have to divide by 10 to the power 7. Similarly, if I have to convert my entire model into just USD, I'll have to divide it by 83. But if I need to convert it into millions as well, I'll have to divide it by 10 to the power 6. So essentially, INR crores means that I'll have to divide my model by 1 crores, and USD million means I'll have to divide my model by 83 million. So this is the currency switch. Now, how to build it out? I will give my user of the model an option that, okay, you have the two options. I'm going to data validation. Here I'll select list and source would be these two options. You can add any multiple options you want. So now if I open the list, I have two options. I can use either of these units to get my model into. Let's say I select USD million for the time being. So now the last step is I use sum ifs. This is my favorite formula. You can use sum if as well. You can use VLOOKUP as well. You can use any formula to fetch data. Sum range is these two, criteria range these two, and criteria is this. So now when I toggle with this particular tab, my cell number O6 is automatically changing. So I will now name this particular cell, just a second. I will name this particular cell as currency or CURR. And last step of this particular thing is to go and manually write divide by CURR wherever I am putting a manual figure. Okay. So this means that my currency now, if you look at it, it is showing as zero point 0.1 USD million. And if I go and toggle here again and put it INR crores, so I've taken 50 lakhs, so it should show zero point 0.5. It is showing zero point 0.5. This is how the currency switch works. You should build it right upfront. And if you go and wait till the end of the model, it will be very hard to find wherever you have punched the manual figures and where it is auto calculated. So always make this a point first. And the second hygiene check which we have to take care from the beginning of the model is color coding of the text. So points to keep in mind, column width and uniform formatting, which we did, currency switch which we have built, text color coding. Here what I do is I use blue if I have to manually punch figures. I use orange if text from another sheet, and I keep it as black if it is auto calculated. Okay. So that is why if you see I automatically did blue here because this was manually punched by me, and here I've linked this to the previous cell. It is auto calculated, so it is black. This is something you should again take care of. Now back to our model, to the cases disbursed piece. So I am using three channels, okay? Performance marketing, organic, and influencer marketing. Let's say for each of these channels, now I'll forecast how many touch points I'll have. Let's say for performance marketing, I will touch 10,000 folks, organic 2,000 folks, and influencer 5,000 folks. And let's say I'm assuming a certain growth rate in this growth percentage, okay, maybe 30% per annum, and then I will apply the formula base into 1 plus growth rate. Similarly, I'll apply the formula to other places as well. Let's assume 10% for organic and 20% for influencer. So this is the number of people or number of cases I will touch. These are not the disbursed cases. But one more thing, you should actually use something known as roundup, because here the cases are coming in decimal. I cannot actually go and reach out to zero point 0.2 people, right? So I have to do round up. Okay, so now my cases or the touch points are in absolute numbers. So these are my touch points. Then I will have a conversion rate for all the three channels. So you can assume any conversion rate again. Let's say I'm assuming a higher conversion rate for performance marketing, maybe 50 or let's say 40%. Okay. For organic, I'm assuming a lower conversion rate of 10%, and for influencer, I'm assuming in the middle again 25%. So the last piece now is my cases disbursed. My cases disbursed will be a function of my conversion rate multiplied by my touch points. Conversion rate multiplied by touch points. Conversion rate multiplied by touch points. Again, we have some decimal numbers here which we do not want, so we will do round up. Or actually, here we can just do round also. Round this comma 0. Hmm. Okay. So these are the total cases I will disperse. Total cases dispersed. Let me do one thing. Now in the notes, okay, let me put it here only. Total cases disbursed will be a sum of these numbers. Okay. And now I have my total cases disbursed and my average ticket size, which means that now I can derive my disbursement amount. So I go to my notes and my disbursement amount. Again, here one more thing. I will have something known as gross. Okay, let it be like this only. I will have my disbursement amount, which is cases disbursed into my average ticket size. Again, one more thing in the model, I am using single decimal places everywhere. So just because you maintain consistency in everything, the model looks very good by the time we complete it. So I get to my disbursements now. Okay. Okay. So now we have our disbursement, and I told you that for revenue from operations, we need our disbursements. So now I will go to my workings and I will make something known as amortization. Okay. Now, what is amortization? Basically, whenever you take a loan or you might have taken a loan in your real life, you will see that the bank gives you a schedule of repayment. That schedule of repayment has three things. It has the total EMI that you have to repay, and that EMI is then further broken into interest component and your principal component. So we need to do the same thing. We need to know the same thing. So here what I will do is I will do disbursement amount. Okay. I will use something gross disbursement and net disbursement. I will tell you why I am doing this later on, but let's for time being have our gross disbursement here and let's take the sum of this. Okay. Now, whatever interest income I have to build, I have to use the amortization method here. So how to do that? There are three key formulas you have to understand. One is your PMT to calculate EMI amount. One is PPMT to calculate principal repayments. And one is IPMT. These are the formulas to calculate interest payment. So here I want to know what is the interest income I will get. So I will have to use IPMT formula. Okay. Now to use IPMT formula, what all do we need? We need the rate, which is at what rate are we giving out loans. We need the per, I will tell you what it is. we will need the N per, which is the duration of the loan, and we will need PV, which is the present value of the disbursement amount. So we need to factor in two more functions here for our disbursements: loan tenure and rate of interest. So this will be percentage per annum, and this will be years. Okay. Let's say 5 years loan, and let's say 18% lending rate. Okay. Now I'm going to my amortization schedule. And now for the last piece, per essentially means that for which year are you building out the schedule. And one more thing you can play around when you use the per piece, that whether it is at the beginning of the year or the end of the year. If I'm giving out a loan at the beginning of the year, I will have interest income and principal repayment from customer for that year as well. But if I assume that I'm giving loan at the end of the year, then I will not have such a principal and interest repayment for that particular year. Got it? Let me do one thing. 5 year model, I'm just assuming some numbers here, right? Now I'm using IPMT. The rate I will take from my assumption sheet, and I'll freeze the row. For per, this is something you should pay attention to. I will use 1, but I will freeze out the row column minus this 0 and freeze out the row. For n per, I will go to the assumption sheet and freeze out 5 ka row. And lastly, for gross disbursement, or I will take net disbursement and freeze out the row. Now you see num errors. This is because I am lending in year 2, this 3460. So for a loan which I have given in year 2, I cannot have any income in year 1. So to just make it more beautiful, I will use if error and 0. So now this is how it looks like. And now to get how much actually my total income is. So for year 1, this will be my total income, and so on and so forth. So this is the total income which I am getting from my customer. Got it? And this total income I can then directly take to my notes to accounts. Here I have to transpose it because it was in a column and I am building out in a row. I will transpose it, and this will be a positive figure. Yeah. Or else you can do one thing, rather than building it out like this, you can go here and take it as negative because this was an outflow for us, so you can take as negative. So automatically you get interest to be positive. So now we have our interest income, and we can actually go and build it out in the P&L as well. Okay. Now the next line item we have is other income. So for other income, what all things we are considering? Processing fees as well as the treasury income. So we have to take assumptions for these two as well. For processing fees, I will assume as a percentage of gross disbursement. Essentially, processing fees is charged whenever a loan is given. So if I am taking a loan, the bank charges roughly 0.25 to 0.5% on the loan amount, which means the gross disbursement amount. So let's say I'm saying 0.5% will be what I will charge to my customers when I give loan to them. And treasury income I will discuss after processing fees. So I can directly build out the processing fees here. Processing fees will be 0.5% multiplied by my gross disbursement. ठीक है? And now treasury income. So treasury income means that you will assume that you will have some surplus cash throughout the year, or some funds which will say that I will have this much fund, and on that fund you will keep it invested with the bank or somewhere where there is very low risk. You will get a nominal return on that particular amount. So for treasury income, we need to have two more assumptions. We need to build out firstly what is our minimum cash balance, and we will build out the treasury rate. Okay. For minimum cash balance, we can take out assumptions. Okay, for minimum cash balance, one way of doing it is again linking it to the disbursement. Given I'm a lending business, I can assume that okay, for at any point of time, I want to have 3 months or 4 months worth of disbursement amount in my hand, and I will not use it unless there is a shortfall in my other sources of capital, which is debt or equity. And hence, I can assume my minimum cash balance to be 4 months of disbursement amount. Okay, which means that I will go and take my gross disbursement and do it 4 by 12. So throughout the year, I will have this much cash surplus or as a treasury cash. And a treasury rate, I can assume, let's say 4.5% roughly as my treasury cash, treasury income rate. So this will give me my treasury income to be 908 into this. Another way of doing it is to take treasury income on average funds, which means that I will do 4.5% into average of these two, opening and closing. So this will change the amount slightly, but I can take average as well. Okay. So I have my treasury income and processing fees. So I can go to my P&L and bring it from my P&L as well. Okay. The next line item we have is employee benefit expenses. Employee benefit expenses. So we need to build out our employee sheet. Now, how to structure an employee sheet? It is very simple. You need to project how many employees you'll have, so the employee count, followed by what would be their average salary, and the function of that would be your employee cost. So I need what? Employee count, average salary per employee per year, and then I will have my employee cost. Okay. So you can make this as detailed as you want, depending on what you're discussing with management. There can be literally 20, 25 rows of employees, but for now, I will just make 3, 4 rows. So we will have some CXOs, your CEO, CFO, maybe a CTO, maybe a CIO or something. We will have some tech folks. We will have some, let's say, admin and management team, and maybe a sales team. Let's add one more, loan officers. So we'll have these 5 level of employees in our workings. Okay. Now you can take assumptions on these employees as well. Let's say I'm saying we will have only 2 CXOs when we are starting, maybe the CEO and CFO, and followed by one more later on. So one more later on. For tech, again, I can assume some random numbers, maybe 5 people and a 20% increment I can assume. So this will be this into 1 plus this into 1 plus 20%. And I'm fixing the column. So now you see the employee count is coming again to become a decimal. So I will do round up. Okay. Now again I can do similar assumption for admin. Let's say for admin I will have 3 people. And for sales I will have a higher staff, let's say 10 people for sales. And now lastly loan officers. For loan officers I will take a productivity related assumption because these officers will be key to my business. They will actually decide how many cases I'm disbursing. For loan officers, let's say 200 cases per officer per year, which means I'm linking this to, I put it, cases per officer per year, and I'm taking 200 cases as the assumption. So which means I'm saying that, okay, one officer will disburse 200 cases, and basis the number of total cases disbursed, I will calculate this. So I will go to assumption, total cases disbursed divided by 200. And again, here I have to use roundup. Okay, why am I using roundup and not round? Because here when I'm getting 27.25 people, it means that I cannot get done with 27 folks. I need 0.25 more, which means I will have to hire one more person. And hence in employee sheet, I'm using roundup everywhere. Now salary assumptions are to be done. So here let's say 2 crores divided by CURR. Okay. For tech team, I will assume what? Tech guy would get paid 50,000 rupees per month. A loan officer would get maybe 70,000 per month. Admin maybe 30,000. And sales maybe again another 50,000. So these are some salaries I've assumed, but you cannot assume the salaries to be stagnant. You have to assume some sort of growth rate there. Okay. So let's say the CXO salary increases by 20% and rest all staff salary increases by 12%. So my salaries will be something like this. Now I have to freeze the column. So this salary is now also factored in the increment or the hikes that the employees will have to get. So this now I can derive my total employee cost by simply multiplying these two. Okay, so this is my total employee count and this will be my total employee cost. So now in my P&L, I can bring out my employee cost from my employee sheet. Do you want to also build like some sort of variable bonus or something? If that is the case, I can actually do that. Let's say I build out my employee cost here. Employee cost, maybe something bonus. So employee cost in that case will be link to my notes. Okay. And now I have to make working for bonus as well. So maybe some assumptions on the bonus. Bonus. Maybe loan officers get paid 200 rupees per case dispersed as a bonus. And maybe let's say sales team gets paid I don't know 50 rupees per case touched per touch point maybe. Okay, so this will be the bonus for the employees. So for loan officers, I will do 200, but you have to divide by CURR. You have to always remember this wherever you are taking an absolute amount per case disbursed. So on the assumption sheet, case disbursed. So this will be my bonus for the loan officers and 50 rupees per touch point. So in the assumption sheet, I need to do a total of the touch points. Just a second. Total touch points. This will be a sum of this, and this. Okay. So now 50 rupees per, sorry, 50 rupees per touch point. So just to be very honest, I do not have anything planned in my head. I'm just building out the model random with you. I am also building it out for the first time with you, looking at the line items and thinking what all things can be there. So if the figures do not make sense at the end, don't worry about it. That is not our purpose either. Yeah, total bonus. So in my notes, I have my bonus also ready. So this gives me my total employee cost. P&L, other income, I'll into the total now, and employee also to the notes में total. Now other income is fine. It's to employee benefit will be negative. ठीक है. Now we need to figure out our operating expenses. So operating expenses. Within operating expenses, we can have underwriting related cost, underwriting costs, which means that for every loan we are giving out, we will have some associated cost. Maybe I will do a bureau check on the customer. Maybe that I have to spend some particular fixed amount every time I'm thinking about underwriting a case, irrespective of whether I actually underwrite it or not. Underwriting means whether I've actually given a loan or not. So that might be there. There might be admin and overheads. Okay. There might be some marketing expenses. I think these three line items should do. So we will take these three line items within our other operating expenses or operating expenses. So now we need to again forecast these three line items. So we'll have to take some assumptions for those line items as well. Underwriting cost. Underwriting cost, let's assume 20 rupees per case disbursed. So let's do one thing. We can assume 20 rupees per case disbursed and 5 rupees per touch point. Yeah. So 5 rupees divided by CURR into the touch point and 20 rupees divided by CURR into actual cases disbursed. So these two will together be my underwriting cost. Because this is in crores and these figures are in lakhs only, so it is coming 0.0. Don't worry about that. Within marketing expenses, we can assume again, let's say, let's do some more detailing here. Sorry, just a small change here. Let me do one more thing. XX per case disbursed and XX per touch point. And let me do it like this. 20 rupees divided by CURR and 5 rupees divided by CURR, and in the notes sheet, then I will add underwriting per case disbursed per touch point, and here I will do the working. Okay, per dispersal 5450 into this amount, and per touch point 17,000 touch points into this amount. So in my assumptions, I can remove these two. Now, similarly for marketing expenses, I'm assuming some sort of CAC or customer acquisition cost of each channel. Let's say for marketing, performance marketing, um, I am spending maybe 50 rupees per case disbursed. Marketing as per case, per touch point only. Let's keep it per touch point. 50 rupees here. For organic, let's say 0 because it is organic. And for influencer marketing, let's say 20 rupees. For influencer, let's say a higher number, 100 rupees. Okay. So now, in my notes, marketing expenses also can be built for all the three channels. Okay. So I will go to the touch points, performance marketing touch points into performance marketing per touch point expense, organic into organic and influencer into in. Now you might think that organic is zero, then why am I building it out? Because it might so happen that at a later stage you want to build out some cost for organic also. In that case, you just change it in your assumption sheet and automatically the model will take it into account. That's the idea here. Lastly, we have admin and overheads. So let's assume this as a percentage of average AUM, gross AUM. Okay. Let's assume this to be maybe 3%. And do you want to increase this in a steady state? That is your call. Maybe we can assume that 4% right now and maybe 3% at a later stage. Okay. So now this we can directly take here to be my uh, average overheads into average of AUM. Okay, we have not calculated AUM as of now, so we need to calculate AUM now before moving ahead. How to calculate AUM now I'll tell you. This also I can do in the notes account actually. I can calculate my AUM here itself. Do not need this sheet for now. The reason I'm deleting AUM is because I made this amortization schedule. So my working has come already here. I'm making it in the notes. AUM is essentially opening AUM plus disbursements minus repayments from customers, which will give me my closing AUM. This is again cross. Opening AUM is 0. Disbursements number I'm taking from here, which means I'm adding disbursements gross. Repayments, you remember we calculated in our transpose amortization. We have not. So this formula will be copied. Now I told you IPMT is for interest and PPMT is for principal. The syntax of PPMT is exactly same as IPMT. So you can just simply go select all, replace IPMT with PPMT, and you'll have your principal repayments in place. It's just as simple as that. So I can now do transpose of this PPMT. And here I have to do minus because this is something I will receive from customer which will be reduced from my AUM. So I'm doing minus. This will be my closing AUM. My opening AUM will be the closing AUM of previous year. Got it? So now I have my gross closing AUM, which means that in my notes, I can now forecast my average, admin and overheads. It will be average AUM gross multiplied by my percentage of admin and overheads I've assumed. So this will be my admin and overheads expenses. And the total of this is my operating expenses, right? So in my P&L now I can have my operating expenses as well. Now there is something known as credit cost, which is essentially the provisioning and write-off we do. Because under an Ind AS umbrella, there is Ind AS 109. You actually have to build out a matrix of exposure at default, probability of default, and loss given default. But in our case, because we do not want to do a very hardcore financial services model, so we will just limit it simply to AUM assumption. So again, if you look at this, what I will do is credit cost. I will assume accumulated provision or accumulated ECL. I will write accumulated ECL percentage of average AUM gross. Okay. Now in such businesses, this is a very substantial figure. So let's assume that we have 3% now and later on it will increase only with time. Let's assume this for now, which means that if I go to my notes, from this gross AUM, I will reduce ECL or my provisions. Okay. These provisions will be calculated as average gross AUM closing multiplied by the percentage which I told you. This will be minus. Okay. So now I have my closing AUM net as well. And my ECL provision is there. So the credit cost, credit cost will be nothing but the change in that ECL which I'm having. So if I go to my notes and I just do the net ECL change which I'm having, this minus this. So the incremental change is my ECL cost because those were accumulated numbers. See, from I had made a provision or the ECL provision of 358 crores in FY27 and FY20 I had to make it to 471 crores, which means the difference or incremental of 112.8 crores will be routed through my P&L account, which essentially becomes my credit cost. Okay, so we are done till credit cost. Now we need to understand depreciation and amortization, for which I will use my asset schedule. So you remember in our balance sheet we assumed two assets. We assumed one property, plant and equipment, and we assumed intangible assets. You can have more line items and the forecasting method would always be the same or similar way. So you can have these two line items and then you will have gross block, total will be a sum of these two. So we essentially do gross block, then we have accumulated depreciation and net block. So now we need to understand the gross block preparation of these two. Okay. So gross block will again be opening, add additions, less disposal and closing. The same format I will take for my intangible assets also. Okay. This is the calculation of closing gross block. So opening is 0 because I'm taking this as the first year. Similarly, opening is 0. Next year opening will be this. Closing will be a sum of this. And my gross block I can link to this closing amount. Now I have to take some assumptions on additions and disposal. So let's say for PP, I will invest 1 crore in the first year, manual numbers blue text, and I will assume that every year I will do 20% of that as my maintenance investment. So 20% means zero point 0.2 or 20 lakhs. Disposal, let me assume zero disposal. This is how my PPE looks like, and then similarly I'll have to take some assumptions on my intangible assets as well. So for intangible assets, because this is I'm assuming a fintech or software oriented business, so that's why I will assume a higher capex, maybe 2 crores, followed by 50 lakhs every year. Okay. So this becomes my gross block, and this is the gross block. This gross block I can directly take to my uh, cash flow statement. So here I can take movements in fixed assets. This will be opening minus closing of every year will be my change. ठीक है. Now we need to calculate the depreciation. So let's assume a WDV depreciation or an SLM. We can take an assumption. Let me take an assumption of a WDV depreciation. Okay. Or let's say SLM depreciation. I'll teach you a new formula also. So for SLM depreciation, again we can use a similar matrix that we did in our PPMT. So there is some formula called SYD, sum of years depreciation, which we can use here. One will be for PPE, will be for intangible assets. So for PPE, I will use SYD. I need cost, salvage, life, and per. Per matrix I have, cost I have. I need to take assumption on salvage and life. So let me do one thing. I'll not go to the assumption sheet again. I'll just save some time. I'll take cost as cost. In cost, you have to take the additions. Okay. So I'll take the cost. Salvage I'll take as 0. Life, let me take 5 years again. And per will be how we did in our PPMT, IPMT. So this matrix, and I'll have to do if error also. And here for intangible assets, this will be my addition or cost. So these numbers are actually my total depreciation, but these are the depreciation for the year and not the accumulated depreciation. So accumulated I'll have to calculate here. Accumulated will be what? This 1.53 or the same I will use for my intangible assets as well. So see the incremental depreciation I can take to my I will take to my P&L, and the accumulated I have to take here. So I'll do a simple transpose here. Okay. Sorry. Yeah, so we have our accumulated depreciation, so we can calculate the net block directly. This will be my net block. Okay. This net block will go to my balance sheet. So PP I can bring from here and intangible assets. In my P&L, I can take my depreciation. Actually, I have to take incremental depreciation. So what I will do, I will take the difference of my accumulated depreciation. Okay. So this minus this. This becomes my incremental depreciation for the year. And lastly, in my cash flow, also I can make the depreciation adjustment profit as per P&L, profit or let's say loss as per P&L. I will take the PAT. See, I will not make a tax adjustment here. I will not do a add back tax as per accounting and then less tax is actual paid. I will just assume that whatever tax is coming as per accounting, that is the actual tax paid. I'm taking PAT here and not doing a tax adjustment. Okay. Depreciation. Yes, I have added back. Okay. So this we have ready. Now we are coming to the finance cost and taxes. Let me just take a break on the finance cost. We'll move on to the taxes part first. Finance cost is very important because I told you debt is the raw material and hence that requires some working. We have to make a debt schedule as well. So let me just put a taxes effective tax rate. So we have 22% into 1.12 surcharge and 1.04 cess. Okay, you can figure out the tax rate whatever you want, not a big challenge. So this will be our PBT into tax rate. And we have our PAT. Now we only want to forecast the finance cost in our P&L. But before that, let's see what all we can do in our balance sheet. So for the closing cash, we can link it to the cash flow statement directly. Okay. Investments, let's say whatever surplus fund we had, we can assume that as our investments. So the treasury cash which we had, this is my investment basically. Loans and advances, AUM we have figured out. Notes, closing AUM. In the balance sheet, you always take the net AUM. Always remember it. Okay. Other financial we have to forecast. Other non-financial borrowings will forecast from the debt schedule. Equity. So in our balance sheet, we need to take some assumptions for equity also. Let's say source of capital, equity raise. I'll just put some random numbers for now. We'll fine tune the numbers at a later stage. Let's say I'm raising what, 200 double zero triple zero double zero 200 crores. Next year no fundraise, maybe a 500 crore fundraise by FY26. So how do I calculate my shareholders fund? It will be my opening shareholders fund plus any fundraise if it is there plus the profit for the year. So this is my equity and I can take some, and here also I can take some. Okay. So now we have to forecast couple of line items for which I will take a general balance sheet assumption. I will tell you what do I mean by that. Balance sheet, balance sheet items, general. See, now in a balance sheet, there are multiple line items. You have to take a call whether you want to forecast each and every line item in detail. For example, I'm building a fintech model or a lending model. So for me, more than trade receivables, the loan and advances play a significant role. Let's say if you're preparing for a manufacturing model, this loan and advances will be immaterial for you, but the trade receivable will be material for you. In that case, you can actually take the receivable days as an assumption, payable days as an assumption, and then actually end up calculating the trade receivable and trade payable basis that. So if you want that also, we can do it separately. But for now, I will take these into our general assumptions and get done with it. Okay. Trade receivables. So I'll take some random numbers for assumptions. 1%, non-financial liabilities 0.5%, provision 1%, maybe this is also 0.5%, random numbers. Okay. And now, one more thing. I've taken random numbers, but I will assume it to be as a percentage of average gross AUM, which is my key driver of the balance sheet. Okay. So my trade receivables can now be calculated as this multiplied by average of my gross AUM closing. And I will fix the rows. Okay. E45, E46, 47, 48, 49, 50, and 51. Trade other non-financial, trade. I've missed other financial. Other financial assets. Okay. So this becomes 46, 47, 48, 50. Okay, so these are my assumptions on the other immaterial or non-material line items. Now the last leg is borrowings and finance costs which we have to project. So I'll do that. So for debt schedule, basically, you have to take an assumption in the model. What we are assuming is that whatever debt we are raising, that will be used for business. Whatever equity we are raising, that will also be used for the business. We are not assuming in the model that any equity raise that we are doing, that will be used for the repayment of the debt. That is not the assumption here. Okay. Repayment or a foreclosure sort of prepayment. That is not the assumption here. So hence, I will have to calculate what is my cash requirement, which is essentially coming from a cash flow statement. So cash from operating activities, cash from investing activities. Third would be cash from financing activities, but I cannot write it here because that is what I'm trying to calculate. Cash from financing activities is a function of equity and debt, and I'm trying to calculate the debt here, so I'm not going to build a circular reference for now. So I will write cash required for debt repayments, and then I will have some available cash. Okay, so cash from okay, I have to do the CFS ka formatting first. So let's say total total, and this will be a sum of this, and this. Okay, so we were in our debt schedule. So let's say operating activities I will pull from here. For investing again I'll pull from here, and debt repayment is pending. Available cash I'll pull from the balance sheet, and I will be taking opening cash here. I actually can take from cash flow the opening cash. Okay, so this should give me my cash required. Okay, for now, let's pause here and jump to another sheet, cash flow statement, and let's try to finish whatever we can here. So here we will have movements or changes in financial assets, changes in non-financial assets, changes in liabilities. Okay. In changes no, in financial assets, I will take trade receivables and others minus trade receivable and others. Non-financial assets now, I will only take this minus this. Change in financial liabilities, I will take trade payables, all these four items. Oh, sorry, I have to take these two here and the other two in the next row. Okay. And movement in fixed assets, movements in AUM and investment. There are two line items left. So investments and AUM opening minus investments and AUM closing. Now in my financing activities, I will have what two items? Equity, debt taken, yeah, repaid. Okay. Equity raise, whatever cash is coming, it will I can take from assumptions itself. So this can be coming from assumptions as is, and debt taken repaid is something I need to calculate from my debt schedule. I think we are all aligned by now. Okay. Now this is the cash I require. So debt taken or debt raise. If the cash required is negative, it means I need cash, and if it becomes positive, it means I don't need cash, which means I'll have to use a formula here that either I will take whatever the amount is or minimum zero. which means if the amount above becomes positive, my cash will become debt raise will become zero. If I make it positive, it becomes zero. And I've used minus to showcase that okay, it is a positive figure which I have to raise. Now, again, because I'm raising debt, I need those IPMT, PPMT schedules to calculate what will be my interest payment and debt repayment I have to do. So here again, I have to take two more assumptions for debt. Debt raise. One will be the tenure and one will be the borrowing rate. Okay. Tenure allow me to assume 5 years only, and borrowing rate allow me to assume a 10% borrowing rate. So this will be IPMT rate will be 10%. Freeze the row per function, do it. Freeze the column minus 0, freeze the row, and then n per will be 5 years. And lastly, you have your present value, which will be the debt raise amount. Freeze the row. If error. Okay. Take the same formula, paste it, and replace IPMT with PPMT. So now we have our IPMT, which is the interest payment we have to do, and the principal payment we have to do. So I can actually link this principal payment here. The model just popped up a circular reference error. So what you have to do is go to more formulas and enable this iterative calculation. When you do this, the circular reference will still be there, but the model will be able to function with the circular reference error. While we build out such models, there will be circular reference for sure, because if you look at it, I am calculating the debt payment here, but this is linked to the debt payment here, and this debt payment is coming from the debt raise, which in essence is coming from the above box, which means there is a circular reference which I have created, and to work with a circular reference, I have to enable the iterative calculation. In the P&L, I will again have my interest cost, so I will link it to the debt schedule IPMT, and I have my interest cost. Okay, my debt raise is here, so maybe I can do one thing. Debt schedule opening, loans taken, loans repaid, closing. I can prepare something like this, right? Opening I have 0. Loans taken will be a function of this particular, oh, sorry, not transpose. Loans repaid will be transpose of my PPMT, and this will give me my closing loans. Okay. The closing loans which I just calculated, I can punch into my balance sheet. In my cash flow statement, then what I can do is debt taken or repaid, I can take either a difference from my balance sheet, or I can do one more thing. I can go to my debt schedule and take a sum of the loans taken and loans repaid. Both the amounts will come as the same amount. Okay. So this is one part of it. I've taken the finance cost, taken the debt, equity raised. Now the difference which is coming in the model is due to the equity raise is what I can see. Okay, the cash flow statement is showing. Oh, sorry, I forgot to link this. So now our balance sheet is tallied, our P&L is done, cash flow is done, notes are done. I did not make any notes for my balance sheet. Fine. Now one more last assumption or one more last adjustment I want to discuss. Think of it, in our notes, what we did was we said, okay, there is some ECL provisioning being done. Now, if my asset is going to 90 plus, as per whatever prudential norms are there, any lending business should stop booking any income on the book on an accrual basis. Only on receipt basis you can book the interest income. But in our case, given we have taken a disbursement approach, we are still ending up booking income on that particular book, which is in this particular ECL piece. So what I will now do is, in my amortization schedule or my income schedule, I will reduce incremental ECL here, which means that whatever credit cost I've shown in the P&L, I will reduce from here. So through this, what I've essentially done is I stopped booking income on this particular credit book, which was credit loss book, which was 70 crores, 38 crores, 141 crores. Now I'm not booking any loss on any interest income on this particular book. Neither am I recording the PPMT or the principal repayment that the customer will do on that book. Why? Because I've already reduced this particular amount from my AUM, which means I've already said that that amount will not come to me. So on one hand, I'm reducing it from AUM saying that it will not come to me. On the other hand, I'm reducing it from my AUM saying that okay, the customer will repay every year this much amount. This is a contradictory approach, and hence what we do is we reduce the ECL from our disbursement amount itself. Our balance sheet will still tally. This was an adjustment to be done from a lending perspective or an FS model perspective. So with this, I've completed my model and now I can quickly build out my dashboard. So dashboard again is built on a similar basis. I will have this particular thing here. Please. Okay. Now I will take couple of things. Operational summary. These are all summary sheets you have to show. Balance sheet summary, P&L summary, and we'll prepare something known as ROE tree, which is basically P&L as a percentage of average gross AUM. Okay. We will prepare these four things. So in operational summary, you can show AUM gross, you can show employee count, you can show any other thing you want. Balance sheet will show total assets, liabilities, and equity. Maybe we can include a debt equity ratio here. P&L, you'll show interest income less finance cost. So you'll get your net interest margin. You'll reduce from that your OPEX, which will be your employee cost plus operating cost plus depreciation. You will have your credit cost and then you'll have your PAT or the PAT only. Let's leave it PAT. Okay. So I'll quickly link the numbers. Here I do not need to do orange because all the numbers will come from my other sheets only. Employee rating and depreciation. Credit cost. This should be my PAT. PAT I'll link because we also have taxes. I will link it to that place. So PBT should be the sum of these numbers. 23.0, 20.7 it is coming. Other income I forgot. Okay. Interest income, finance cost, NIM, other income. 20.7. Perfect. So this is how my P&L summary would look like, and I'll take the same rows, copy here. AUM gross I'll link from my notes.
gross AUM, employee count from my employee sheet. There is some error in this formula. Okay, we have taken 200, but the this cell we have not frozen. I need to freeze column D. Now it is fine. How I found this error was because the employee count was decreasing, but it should not be the case because the business is increasing. So I found this error through the dashboard. D is frozen, D frozen, D frozen. ठीक है, looks fine now. Employee count we have. ठीक है. Balance sheet summary I'll take quickly. Assets total here we have. Liabilities total will be these rows, and then I will have my equity as this. Debt equity ratio will be borrowings divided by equity. Here I can just do one more thing. I can do more number formats, custom, and make it 0.0x because this is x times debt equity. This again I can do. Okay. Now these numbers are to be linked to my average AUM. So the absolute amount divided by average AUM gross, and I will freeze the rows and quickly paste the formulas. Here actually I will do one more thing. I will introduce a check. Uh, Till PBT actually we can put a check if we are linking it correctly. And this is correct, okay. Now PAT is also known as return on assets or return on average assets, and I'll also introduce one more thing. ROE or the return on equity. Okay, return on equity you can calculate as your PAT divided by average equity. Okay, so this is how the model is looking right now. Now quickly a hygiene check we will do on the model, that using the ROE tree we'll figure out if there are any logical errors. The formula errors I think we have eliminated. But for the logical errors in our assumptions, as I told you that I am building the model with you, I do not know how it will come up to be. So we'll have to check for logical errors. So now we have broadly completed the model and the dashboard sheet. The last thing you can do is check whether the things we have done are working or not. So let me just demonstrate how. Let's say we have 13,000 crores worth of AUM, and if I were to convert it into 80 USD million, so I would divide it by 83 and millions, so into 10. So I would have roughly 1616 if I toggle it. So see, we have 16.1, which means that the currency switch is working fine. Even in the PNL, we have 704.1. So 704.1 divided by 8.3. I should have 84.8. 84.8 working just fine. First thing, the currency switch now has been done very well. Next thing is to understand the sanity of the model. As I told you, I was building the model along with you, and I didn't know what the numbers would show up to be. But if we look at it, the interest income is 20% for the first year, and then suddenly it jumps 28 to 26%. There is a logical reason for it. In FY25, we have an existing AUM of FY24 on which we are getting interest income. And we have a new book of FY25 again on which we are getting interest income. But in FY24, we had only our new book, and hence the interest income as a percentage of average AUM will be lower for the first year of operation compared to the next year. So that is fine. In the finance cost, the finance cost seems to be reducing with time. The main reason for that is this row, leverage. As and when our business is progressing, we are not taking more and more debt, but we are also having our own funds or our profits to do our business. And hence our leverage is reducing from 17x to 6x, resulting in our finance cost reducing from 16% to 15%. Okay. Or let me say 19% to 15% because this was the first year of operation, as I told you. So resultantly, my NIM or net interest margin has expanded from roughly 9% to 11%, and my other income is what it is. OPEX is what it is. OPEX, obviously, we have assumed employee operating and depreciation assumptions. So it is a function of all those things. Credit cost, if you look at it, first year was 3%, but it has gone down to 1%. And whereas what assumption we had taken, we had assumed an increase. So it is reducing because we had assumed an increase for the gross AUM and not for the incremental piece, which means that we need to increase our assumptions here over the gross AUM as well. So let me do one thing. Instead of 4, I will take 5, and here I will take 5.5%. Okay. So now my dashboard will show me some different number that for FY25 it is a very low numbers. For FY25 itself, I will increase it to 5. Then maybe let me do one thing. I will increase it by 1% per year. Okay. So now my dashboard shows a better off number, which is here. And the resultant number or the PAT is what you see, 3.5% in year 2, 3.4% in year 3, which is almost same. And then it jumps slightly to 4.1% and 4.3%. This is due to the drop in leverage. The main reason is drop in leverage. How to play around with this? Now I'll tell you that. Let's say that instead of the 500 crore equity raise, I only raise 200 crores. Sorry, 300 crores. In that case, you look at this. My NIM is now this. Let me do one thing. I'll just paste these 4 years here. Okay. And this is when I'm taking a 300 crore equity raise. But if I take a 500 crore equity raise, which I had taken earlier, you see the difference. Where my NIM with a lower equity raise, with a higher equity raise, my NIM is also higher because I'm using less of my debt money. But with a lower equity raise, I'm using more of my debt money, which means my interest cost is higher, which means my NIM is lower. So instead of a 10.2%, I'm having 9.9%. Instead of 10.4, I'm having 10.1%. So that is something you can play around with. Similarly, you can play around with the leverage numbers as well. So if you look at this, let me remove the first year. It will be a bit anomaly. So now I am having these numbers if I'm assuming a 500 crore equity raise. But if I go to the assumptions and change it to let's say a 200 crore equity raise, my leverage should increase. So instead of 6.8, 8.6, 7.4 ki jagah 10. So those leverage numbers have increased, which means my finance cost will increase and my resultant NIM figure would also reduce compared to when I assumed a 500 crore equity raise. Other ways of playing around with these numbers is you can spread out the equity raise. You can assume a 100 crore equity raise here. You can assume a 100 crore here and a 100 crore here. That will change the scenario altogether. Okay? So you can play around with these assumptions. I will share the model with you. I will put it in a drive and share the drive link in the description if you want to have the Excel version of it. Now just I've completed the model, so a couple of closing remarks. One, I had taken a annual assumption, so I made an annual model. You can also make a monthly model or a quarterly model. The difference is not that it will be more hard or more complicated, it will be more lengthy. Only that is the difference. You'll have to take similar assumptions, but let's say if you make a 5-year monthly model, you'll have to take it across 60 columns instead of 5 columns. So that is the change that will be there first. Second, um, as I told you in the beginning, I'm doing only modeling right now and not valuation. So that is the purpose of this video, and we also completed the modeling part of it. You might want to do valuation, which is a separate discussion we can have. You might want to understand how to build a terminal value, and then do DCF. Again, that is a separate discussion. Third, this was a lending business related model. You might apply the same logics to build it for a B2B SaaS business or for any other tech related business or anything you want. You can build it out in a similar way for any business. There can be one or two different variables, but broadly the logics and the method would be the same. Lastly, there are a couple of other things which we can discuss. For example, how to understand retention cohorts, how to understand static pools. So if those are something that you want to discuss, just let me know in the comment section and I can make videos on that as well. So on that note, I think we have covered how to build a financial model in detail and covered all the sheets which we had discussed initially. So with that note, or on that note, I'm ending this video. Thanks for watching.